Hi, my name is Brenton Harrison, and we're here today to talk about how company benefits impact those who are highly compensated employees. Let's get started. I don't know if you remember this, but I vividly remember the time when I started seeing advertisements for a website called The Ladder or theladders.com. And it advertised itself as almost a LinkedIn for high income earners. As a matter of fact, if you were going to be on the ladders, if you were a job seeker, then you were someone who was in a position where you were going to earn at least $100,000 a year. And if you were a person who was looking for someone to fill that job, then you could know that all of the candidates were people who were verified and qualified to earn at least six figures in income. And at the time, I wasn't yet working. I remember thinking, how are there that many people out there who earn over $100,000? And if there are that many, what problems are they talking about that they could possibly have? That's what I thought at the time. But the longer I'm on this earth, the longer I work, and the more that I'm experiencing and the more that I'm exposed to, you start to realize that when you get to higher and higher levels of income, it doesn't mean that you are somehow devoid of problems. As a matter of fact, some problems creep up that weren't there before. You have increased professional privilege fees or insurance costs and needs, increased taxes, all of these different things that you didn't have to deal with when you were making a lower salary. Now, I'm sure you don't want to go back to making a lower salary, but the fact remains that when you're highly compensated, there are some areas where the things that are affecting you are different than how they're affecting those that are a lower pay scale. And nowhere is that more evident than in the area of employee benefits. So we want to talk about a few areas where employee benefits specifically affect those who are high income earners and how you can use those to your advantage, or at least know how some of the ways that put you at a disadvantage can be supplemented by personal planning. Let's get into it. The first area we'll touch on is the maximum match on a 401k or 403b plan through your employer. And this is the first area where you'll hear the term reverse discrimination. And reverse discrimination is a concept where the more money you make, the less you actually get to participate in some of the employee benefits that are offered at your job. Maximum 401k match is an example because what you see in this instance is employers will match the contributions that their employees put into their retirement account. As an example, let's say that you work for a company that says they'll match the first 5% of contributions that you put into your retirement account. So if someone earns $50,000, then if they put $2,500, that's 5% of their pay, into a 401k, then their employer will match that $2,500 and a total of $5,000 will go into that retirement account. But what you often see is employers will counter that match with a maximum amount that they'll place in matching contributions. As an example, that same company may say, we'll give a 5% match on employee contributions as long as it doesn't exceed $10,000. And what that means is they will match what you put into your 401k, but if that goes above $10,000, that 5% that they're offering, they will stop at $10,000 even if you didn't get the full 5% match. So let's go with that example. Let's say that they do a 5% match up to a cap of $10,000. Well, that means if you do the math, that anyone who earns $200,000 or less will be able to take advantage of the full match because 5% of their pay doesn't exceed $10,000. So they'd be in a position where, for example, a person who earns $200,000, they could put aside $10,000 of their pay and their employer would match $10,000 and a total of $20,000 would go into their plan. But once you earn more than that $200,000, you're now in a position where 5% of your pay exceeds the $10,000 match that they've capped. And that means that it doesn't matter if you put the full 5% of your pay, you will not receive that full match on contributions, even though everyone else below you in income is actually receiving it. If you're in this position, you would want to know ahead of time so that you know you're not getting the full match even though someone else is offering 5%. And if you want to supplement it with your own planning, you can do so. But this is one area where high income earners are reverse discriminated against when it comes to the result of their income and the impact on its employee benefits. The second area where this concept rears its head in terms of retirement accounts is in the maximum amount that you can put into a 401k or 403b in the first place. So depending on the year, you might find that the annual contribution max that you can put into this plan is $18,000 or $19,000 or $19,500 in terms of what the employee can put aside on an annual basis. Doesn't include matching funds, but for example, if the IRS said that this year you can put $19,500 in your account, then you'll be able to put up to that dollar amount before you lose the ability to contribute on a pre-tax basis in that 401k. Now, this is important because when you talk about retirement accounts, even though $19,500 is a lot to the majority of people in this country, there are people out there who are earning hundreds of thousands of dollars where that $19,500 or $19,000 or $18,000 wouldn't be enough to allow them to save to the point where they can meet their financial goals. The more money you make, the more money you have to save in order to replace that income when you start working. So for someone who earns $50 or $75 or $100,000, even $150,000, being able to put aside that amount of money may be more than enough for them to reach their financial goals. They may be even able to retire early based on the income they desire in retirement. But someone who earns $400 or $500 or $600,000 may find that that amount they can put aside is inadequate in order for them to reach the goals that they have in retirement. This means that they would have to ask if there are separate benefits that their employer offers in terms of the ability to put aside money, which we'll cover in a second, or if not, they would have to go outside of their employer to look for options beyond their work retirement accounts to be able to put aside the amount needed to retire on their own terms. To make up for the limitations that are offered, or I should say placed on retirement plans like a 401k or a 403b or a 457 plan, some companies have offered their high income earners what's called deferred compensation plans. Deferred compensation plan works in some ways similar to what you might find in a 401k in the sense that the money that you put aside can be taken away before it's charged in terms of income taxes. That money might be able to grow tax deferred, meaning that you don't have to pay taxes on the growth year after year. But the concept of deferred compensation plan is that high income earner can pick a percentage of their pay or a set amount of their pay that they simply don't want to receive this year. They can decide, I don't want you to pay it out to me. I don't want to pay income taxes on it. I want to defer that compensation so that I can receive it at a later date. For example, you might say, I want to defer 5% of my compensation for this year, and I don't want it to be paid out to me until the year 2035. So if we're recording in year 2020, 15 years from now, the amount of income that you deferred would be paid out to you as income, and you would pay income taxes on it at that time as if you earned it in that year. Now, this is an option for high income earners who are trying to boost the amount that they are putting aside on an annual basis when it comes to retirement or just in terms of general investments. But it also puts them in a position where if you're a person who has managed their budget well and you don't need all of the income on a yearly basis, that just from a pure tax planning perspective, you can help avoid paying some of those taxes now in lieu of paying it at a later date. Now, depending on your organization, your corporation, your deferred compensation plan could have different rules. It could have different investments in which you can place those funds. But if you're wondering if you have that available, then during your open enrollment time or just at any point in time, ask your HR office or your employee benefits representative for all of the options available to you in terms of retirement planning and deferring income. And you might find that this is an option that you have available to you that you weren't aware of beforehand. Another tool that many organizations use to incentivize their higher income earning employees and oftentimes to keep them around for a certain period of time are restricted stock. Restricted stock, in essence, is a way for an employer to give a gift of stock in that company to an employee, but in order for them to get all of the stock, they have to stay with that employer for a certain period of time. So let's say, for example, that I have an employer who says that over the course of 5 years, I'm going to be granted 1,000 shares of restricted stock, but I'll only be offered 200 shares a year for 5 years. So in order to get that full offering, I have to stay with my organization for the entirety of the 5 years. Otherwise, I'll be leaving some of that money on the table. Restricted stock offering is something that is more valuable based on the improvement of the stock price of that organization. So if you are a high income earner and you were working for Amazon 15 years ago, for example, then a restricted stock offering may be something that was really beneficial because you're looking at something that's going to increase in value over time as long as you stay with the employer long enough to receive the full offering. Now, employees of all income levels may be offered an employee stock purchase program, and that typically is a program that's offered to a much wider range of employees where they can essentially buy stock in that organization at a discounted price. That's something that's a little different than restricted stock, whereas restricted stock is something that you typically see with a highly compensated employee. And if you are negotiating an offer or wondering how those benefits work, it's something to inquire about so that you have an idea of not just how long you have to work at that company before you can access that stock, but also what are the rules on selling it. Because you might decide that, hey, it's great that I have all this stock in a different organization, but maybe I want to diversify a little bit. I don't want this much of my portfolio tied up in the dreams and the hopes and the aspirations of one company. So some may decide to keep a portion of it in their restricted stock and sell off other portions so that they can invest in other endeavors. You might decide to keep 50% of your restricted stock, but sell off the rest so that you can buy into other areas of your finances. Having an idea of your strategy with restricted stock is something that's very helpful as you not only assess your future with that organization, but also the diversity of your overall portfolio. Next up, we have Roth 401ks and 403bs. These have been great tools for people who are high income earners who have wanted for years to take advantage of some of the offerings that come with Roth retirement accounts, but haven't been able to do so because they earn too much money. So let's do a quick recap of pre-tax retirement accounts, which would be traditional accounts, and post-tax retirement accounts, which would be Roth accounts. Pre-tax retirement accounts are accounts where the money that you put in is not subject to income tax. For example, let's say that I put $5,000 into a pre-tax or traditional 401k and I was earning $100,000. Well, that basically means that even though I earned $100,000, because I put $5,000 of that money in a pre-tax retirement account, then when I go to file my taxes the next year, I will not have to pay taxes on that portion of my income. It will look as if it disappeared. $5,000 would be taken away from my income, and I would only have to pay on, at maximum, $95,000 in this scenario. Now, in exchange for that, that money will grow and grow and grow. And when I take it out in retirement, I would be taxed on it as if I earned it. So let's say that I put $5,000 a year aside in pre-tax retirement accounts, didn't pay taxes on it the whole time. And maybe in my first year retirement, I take out $50,000 from that account. Well, that year, it would make it look as if I earned that $50,000 and I would pay income taxes in retirement. I didn't pay on the front end, so I pay on the back end. Roth accounts are the exact opposite. With Roth accounts, you pay taxes on every dollar of your income that you put into these accounts on the front end, but on the back end in retirement, when you take the money out, it is not subject to income taxes. So many people prefer Roth retirement accounts because they can get their taxes out of the way so that when it comes to retirement and they want to maximize the amount that they can spend, they don't have to worry about income taxes at that time. Now, before the invention of Roth 401ks and 403bs, people who earned above a certain income couldn't utilize Roth accounts because the only way you could use them was through Roth IRAs, which is a Roth individual retirement account. And these accounts had income restrictions that would place a cap on those who could participate and those who couldn't. Well, thankfully, Roth 401ks and 403bs do not have income limitations. So this is an option for high income earners who have been priced out of Roth IRAs to put themselves in a position where if they choose to, they can take advantage of the Roth opportunities offered in their retirement accounts through their employer without worrying about those same income limitations. Next, we have group disability insurance. This is a huge one in terms of the amount of times or the percentage of the time I see it overlooked by high income earners at small businesses or corporations. Disability insurance is essentially paycheck insurance. It's insurance that protects and replaces a portion of your income if you're ill or unable to work. You have short-term disability insurance, and then you have long-term disability insurance, which is typically for an illness or an injury that keeps you out of work for 3 months or longer. And long-term disability insurance is another area where with many employers you see the term reverse discrimination rear its head. Because what you'll often see with group disability insurance, which is disability insurance through your employer, is that they will replace a percentage of your income as long as it doesn't exceed a certain amount. For example, you might see that the typical group disability policy aims to replace 60% of your pay in the event of an illness or injury. So, for example, if you are earning $100,000 a year and you experience a long-term disability, then that disability insurance policy will replace 60% of that, in this case, $60,000 for the year, $5,000 a month, and you would have that portion of your income replaced as you hopefully recover and try to make yourself back to work, back whole. The problem is that you also, similar to the employee match, will often see a cap on the benefit that you see with these group disability plans. So, for example, they may say that they'll replace 60% of your income in the event of an illness or injury as long as it doesn't exceed $10,000 per month. So going back to our $200,000 income example, if you earn $200,000 a year, then 60% of that is $120,000 for the year, which is $10,000 a month. If you earn that amount or below, then the limit that's placed on that disability limit wouldn't bother you. You would have your full 60% replaced in the event of an illness or injury. But if you earn above that $200,000, then again, you would be in a position where your full 60% of your income would not be recovered because it exceeds $10,000 a month. This would be one area where you might need to supplement your group disability insurance with an individual policy of your own. But I'll go a step further, because many high income earners, if they're hourly, they may get bonus pay or hourly pay that's double pay if you're like an ER physician where you get paid more than your base rate. Or if you're with a corporation, you might get a big bonus on a yearly basis that you depend on when it comes to your income from year to year. And unfortunately, most group disability policies only cover your base pay. So if you have a lower base pay or you have a significant bonus, that amount is also uncovered by your group disability policy in most instances. So if you want that covered, you would need to make sure that you have an individual policy on top of the one offered by your employer. But what's worse is if you have your disability policy through your employer, it's also likely that they help contribute to a portion of the pay in terms of what it costs to have that coverage. They may cover 50% of the premium or 75% or 100%. And unfortunately, whatever percentage your employer pays for on the front end in terms of the cost of that policy, that same percentage would be taxable to you as income on the back end in the event of a long-term disability. So, for example, let's say that you're earning $100,000 a year and you're depending on getting that full $60,000 if you were disabled. But you find that the policy that you paid for on the front end was paid for 100% by your employer. Well, that means that if you receive that benefit, 100% of what you receive would be taxable to you as income, meaning you would not even get the full $60,000 you were due to receive. You'd have to pay taxes on it. All of these things factor into the decision of whether you need to supplement that disability policy with your own, and you should have these discussions with your spouse, even with just your own financial professional, as you decide and look at your income and the benefits your job offers to see what needs to be added to that equation to make yourself whole. Lastly, we have HSAs, FSAs, and dependent care FSAs. HSAs, FSAs, and dependent care FSAs are accounts that I have talked about so many times that people get sick of me talking about it, but I keep bringing it up because it is an easy way to help out on your taxes when it comes to tax deductions, but also an easy way to set aside money for things that you already pay for when it comes to your health in a way that will save you money and save you taxes at the end of the year. Here's how a health savings account works. A health savings account is an account where you can set money aside to pay for certain health-related expenses. Now, to have a health savings account, which your employer might set up, and they may say you can put aside, a certain amount each pay period into your health savings account. Well, in order to have that, you have to pair it with what's called a high deductible health insurance plan. Here's what that means. When you sign up with open enrollment for your health insurance, one of the things that you look at when you're evaluating plans is the deductible that you have to pay. The deductible is the amount of money you have to pay for your care before your insurance company starts sharing in those costs. For example, let's say that I have a $5,000 deductible. That means that I'm responsible for paying for the first $5,000 of my care in full, but after that point, my insurance company may share in those costs. They may pay 80% of everything past that point, while I only have to pay 20%. That's what a deductible means. It's the amount of money you have to pay before the insurance company helps share in those costs. Well, when it comes to high deductible health plans and health savings accounts, you have to pair your health savings account with a high deductible health plan, which means that you would be responsible for more of your care before the insurance company sets up. That makes sense because they're giving you the option of setting that money aside, so it would make sense that you would have to pay for more of it in order to receive that benefit. Now, the good thing about high deductible health plans is if you are responsible enough to put the money in the HSA, the premium on high deductible health plans are typically the lowest of the options that you'll find with your employer. So you'll be saving for yourself in terms of your health costs, and you'll be saving money on your health insurance. The other thing about high deductible health plans and HSAs is the money you put into your health savings account is also something that you do not have to pay income taxes on. So just like in a pre-tax retirement account, where if you put $2,000, for example, in a health savings account, you would not have to pay income taxes on that $2,000 at the end of the year, which allows you to keep more money in your pocket. But lastly, for high income earners who are trying to find a way to put money aside in a way that allows them to save for retirement, when you have money in health savings accounts, until you're 65, that money has to be used for health related expenses. But after 65, any unused money that you have from year over year rolls over and rolls over and rolls over and rolls over and grows and grows and grows. And age 65 and beyond, you can use money in health savings accounts for whatever you'd like to. It does not have to be restricted to health expenses. So in some cases, this can be another option where, if not needed for health, those funds can be used to supplement retirement funds for high income earners. That's a health savings account. Now, a flex spending account works a little differently. A flex spending account doesn't have to be paired with a high deductible health plan, so you can use it with any health plan you'd like. The money also doesn't roll over from year to year, so you wouldn't have the ability of just continuously growing. Any unused money at the end of the year is lost, but fortunately, it is still a pre-tax account, so you do not have to pay income taxes on the amount that you put in your flex spending account. Lastly is dependent care flex spending accounts. And this is the most underutilized benefit in my experience of people who have employee benefits through their job. A dependent care flex spending account is an account where you can put aside money pre-tax for things that you pay for your dependents, your children, even a senior that's in your care, like a mother or a father. You can pay for adult daycare or daycare. You can pay for certified babysitters. You can pay for summer camp. You can pay for registration fees for your kids for things that come out of that dependent care flex spending account and not have to pay income taxes on those items at the end of the year. So if you have all these things that you have to pay for anyways, you might as well get a tax deduction for paying for them through your dependent care flex spending account. These are just a few ways that high income earners are impacted by the employee benefits at their employer. I hope this is something that was valuable to you and that you'll tune in to videos coming from our channel in the future. If you haven't already subscribed, please do so and hit the notification button so you know when new videos are posted. My name is Brenton Harrison. We'll have more videos coming your way soon, and I'll see you then.